chapter 7, and this will be the most new knowledge that we will gain in intermediate accounting. And then prior portion, part 1 is basically financial accounting review, right? So we wanted to focus on how to financing the receivable. There's a two way that we can financing receivable. Financial institutions have developed a wide variety of ways for company to use their receivable to obtain the immediate cash. The companies can find this attractive because it shortens the operating cycle by providing cash immediately, right? And then also many companies avoid the difficulty in serving billing and collecting receivable by having financial institutions take on the roles. Of course, the financial institution require compensation by providing these services, usually interest and the financial charges. The various approach used to finance with receivable differs with respect which rights and risks are certainly being transferred, right? Transferable, and which are passed on to the transferee. Despite this diversity, these approaches can be described either as a secured borrowing or sales of receivables. So secured borrowing means that you use the receivable as a collateral for a loan, and then entire receivable balance is served as a collateral, and the responsibility for collection of a receivable remains as the transferor, means the ones who have these receivables. And the arrangement should be described as in the disclosure notes, and no special accounting treatment needed. But if you sell the receivables, then it can, first of all, it can be sold at a gain or loss, like other asset, and accounting treatment is similar to sales of other assets. So there's two kind of secured borrowing. One is called pledging. So sometimes company pledge accounts receivable as a collateral for loan. So no particular receivable are associated with the loan, right? Rather, the entire receivable balance are used as a collateral, okay? The responsibility for collection for the receivable still remains with the company itself, and no special accounting treatment is needed, but arrangement should be described in the disclosure notes. Okay, and then, so for example, a disclosure of receivable used as a collateral, such as a Vicro Management Corporation, the arrangement of pledging receivable should be described as in the disclosure notes, such as liquidity and capital resources, right? The revolving credit facilities is an asset-based line of credit that is subject to borrowing base limitation and generally provided for advances up to 85% of eligible accounts receivable. This means that they use the accounts receivable to pledge a line of credit. And this line of credit can only goes up to 85% of accounts receivable. Okay, and then the second kind of secured borrowing called assigning. Okay, so alternatively, company can assign particular receivable to serve as collateral for loans, such as mortgage on a home, right? The lender typically lends amount of money that is less than the amount of receivable assigned by the borrower, and the difference provides some sort of protection for the lender to allow for possible uncollectible accounts, right? Say if you have accounts receivable of $1 million, and then you use this to assign it to a loan, right? Back up a loan, hence that the loan amount will be much less than 1 million, because we don't know how much of this 1 million will be collected, right? So the lender usually also charge the borrower some upfront financial charges in addition to the stated interest on the loan. So in other words, if you loan me $800,000, not only I will charge you interest, let's say at 2%, and also I will charge you fees to loan you money. Okay, so based on the accounts receivable. The receivable might be collected either by the lender or the borrower, depending on the details of the arrangements. So December 1st, 2021, the Santa Teresa Glass company borrowed 500,000 from a financial bank and signed a promissory note. The interest is actually 12% payable monthly, and the company assigned $620,000 of a receivable as a collateral for the loans. The financial bank charges a financial fee equal to 1.5% of accounts receivable. Hence that you were getting the cash, right, of only what 500,000 minus the fee that they charge. Basically, you have a loan of 500,000. The fee is 620,000 multiple 1.5%. The 620 is accounts receivable value, and multiple the fee of 1.5% give you 9,300, and hence that your cash really deposited in your bank is only 490. And then Santa Teresa will continue to collect, which is the transfer role, continue to collect receivable and will record any discount, sales return, and bad debt write-offs, but will remit the cash collection to the finance bank, usually on a monthly basis. Assume that 400,000 of receivable assigned are collecting in December, hence you will debit in cash and credit the accounts receivable for 400,000, and then you will remit that 400,000 immediately to reduce your liability of financing arrangements, which is here, right, 500,000, and also you will have to pay the interest payment of that 12%. Remember, they also charge you 12% of monthly interest, right? Which is 500 multiple 12% multiple 1/12, which is 5,000, and you credit in cash for 5,000. And then assignment of accounts receivable concluded is that you have accounts receivable of 620,000, you'll collect the 400,000, which you left 220,000 to go. And the liability financing is that you borrowed $500,000 and you only paid off 400,000, and then you still left 100,000 to go. Okay, so the second thing that we want to deal with is sales of the receivables, right? So the sales of receivables, the accounting treatment is very similar to accounting for sales of other assets. So the seller first has to remove the receivable from the accounts, and also recognize at the fair value any asset acquired and liability assumed by the seller in the transaction, and then record the difference as gain or losses. Let's look at it. So we call that the sales of a receivable as a factoring arrangement, right? There's two kind of way to sell your receivable. One is called factoring. What is factoring? Factoring means the company sells the accounts receivable and the financial institution or the factor. And then first of all, they will buy the accounts receivable, and also they were charging a fee for these services. And then also the financial institution assume the billing responsibility to collecting that accounts receivable and the collection of the accounts receivable. And then there's another way to sell financial receivable. It's called a securitization. So in other words, the company itself creating a special purpose entity, and its entities buy back the company's trade receivable, credit card, and all kind of receivables at the same time where the money come from, right? This is outflow. The inflow is to issue securities such as gather money from the stock market, or borrowing money using bonds, or issue bonds or commercial papers to back it up, right? So it sells related securities, typically debts such as bonds and commercial letters, right, to inflow to get money, and then use the money to buy back the receivable from the mother company. Okay, if a factoring arrangement is made without recourse, that means the buyer cannot ask the seller for more money if the receivable has proven to be uncollectible, right? When a company sells accounts receivable with recourse, that means the sellers retain all the risk of the bad debts. So to compensate the sellers for the retaining the risk of bad debts, the buyer usually charging a lower factoring fee when the receivable are sold with recourse. In other words, that if you sell to the financial institution with recourse, that means that you still bear all the risk of bad debts, right? Hence, that in that case, the financial institution, when the fee that they charge you will be much lower, because you take the risks. But if you are factoring the receivable without recourse, that means you transfer all the risks 100% to the financial institution. Hence, that they will charge you relatively higher fees. So let's look at this example. In December 2021, the Santa Teresa Glass Company entered into following factoring arrangement with the factor bank. Santa Teresa transferred accounts receivable that had a book value of $600,000, and the transfer was made without recourse. Okay, so that means that the factor bank will take over the collection and risk of bad debt. And the factor immediately remitted the Santa Teresa cash equals 90% of factored amount. So 90 multiple 600,000 is 540. And factor retains the remaining 10% to cover its factoring fee. So basically, factoring charging 10% of its factoring fee, which equals 4% of total factoring amount, means that 4% multiple 600 is $24,000, which is the fee. Factor fee charged by the bank to provide a cushion against potential sales return and allowances. After factor has collected the cash equal to the amount advanced to Santa Teresa plus the factoring fee, the factor will remit the excess to the Santa Teresa. Therefore, Santa Teresa has a beneficial interest in transferred receivable equal to the fair value of the last 10% of the receivable to be collected, which management estimate is about $50,000 less the 4% of the factoring fee. In other words, once the factor, which is the bank, collecting as much as they can, and then surpass the cash that give to the the transfer role, the leftover after reduce the factoring fee will remit it back to the factor. So in other words, you only give people in the bank only give you 90%, so you debit cash of 90%, right? And then of course you write off your accounts receivable, take off the accounts receivable from your book of 600,000. So the in between there's a $60,000 with a $60,000 girl. So first of all, you know that if they if they collecting everything surpass by what they borrowed you, the difference is $60,000. However, you only estimated there will only be $50,000, not $60,000, right? Because there's some bad debt and allowances in here. You cannot 100% collecting everything. So you assume that's gonna be $50,000, and then you know the fee they will charge is $24,000. Hence, you were only expecting $26,000 will be paid back by the bank to you, right? They call that beneficial interest. Okay, this is beneficial interest, and then the difference is going to be plugged in, which means that you're losing money by factoring this accounts receivable. The loss is $34,000. Okay, and then if you actually factor with recourse, assume that the same effect is in previous illustration, except that Santa Teresa sold the receivable with recourse and estimated fair value of recourse obligation is $5,000. So basically, you get rid of your receivables for $600,000, and they will still only deposit $540 for you. And also, you take on a new liability, means that if anything didn't collect, you have to owe them $5,000 of liability that you will take on, and your receivable, which is your beneficial interest, is still the same as the previous case, which is $50,000 at most. They will collect more than the cash amount they give to you, and then minus the fee that they charge you, which is $26,000. Hence that you will find you're gonna lose more money because you taking on extra liability. Okay, so you will lose $39,000. Okay, so the next thing we want to talk about is a transfer of notes receivable, which we want to talk about discounting, right? So companies can obtain immediate cash from a financial institution either by pledging a note as a collateral for a loan or selling a note. So in other words, you have a note receivable, you pledge the notes to financial institution and they give you cash, right? And then we wanted to know how much the financing fee it is for this transaction. Basically you wanted to know the cash amount the financial institution will give you. You will use the maturity value of the note minus the discount that financial institution will took, and then you can figure out the cash pledge, and then the difference is gonna be the financing fee. Let's see a more clear example. Okay, so on December 31st, the Stridewell Wholesale shoe company sold the land in exchanging for 9 months 10% notes. Okay, December 31st, 2021. And then the note requires payment of $200,000 plus interest on December 30, 2022. And the company's physical year end is December 30, and the 10% rate probably reflects the time value of the money for this type of the notes. The March 31st on year 2, Stridewell discounting the note at Bank of East. The bank discount rate is 12%. Basically, bank charge 12% effective rate. So first of all, you want to accrue interest earned on the notes prior to being discounted, right? Prior to you pledge it. So that means that from January 1st, 2022 to March 31st, 2022, before you sell the notes, because you sell the notes on March 31st, right? Yeah. And then, so you were debiting the interest receivable from from whoever owed you the notes receivable, and credit interest, which is $200,000. You charge them 10%, and 3 months out of 12 is $5,000. Okay. And step 2, you wanted to add interest to the maturity to calculating the maturity value. So what is the maturity value here? First of all, you wanted to, the face amount is the 200,000, interest to maturity, which is 9 months notes, right? From January 1st to 9/31st, so 9 months. Hence the interest that you're supposed to collecting on this note receivable before you pledging is 215,000. However, you know that the bank that you pledge against is only 6 months you pledge against, and then they charge you 12% of interest rates. Hence, in the future, that means that $215,000 is the base maturity value, multiple the bank's interest rate, multiple 6 over 12, which is half year, and then that gives you, they will give you a discount. They will discount your notes receivable about 12,900. Hence, the cash proceeds, they will only deposit 202,100 to you, and then you deduct the discount to calculating the cash proceeds. Okay, so in other words, that you were debiting the cash of 202,000, and then you definitely will get rid of the notes receivable because the notes is not yours anymore. And then you know that the interest revenue and you is a 500,000 because here is a 5,000 because your interest revenue is 5,000 here. Hence that you have to debit loss of 2,900. right? Because this is because you debit the interest receivable from January 1st to March 31st, 2022, and credit the interest revenue, right? And then when you pledge it, you pledge the rights of the interest receivable as well. So basically, you get rid of entire notes itself and notes received waiting to be paid the interest receivables, and you pledge only 202,000, and difference will be the loss. Okay, so the preference for transfer or sell, you wanted to sell. If you're a company, you want to transfer, or you want to sell the AR, or you wanted to secure borrowing. So there is a good bad side, right? So first of all, does the accounting approach de-recognize accounts receivable reducing asset? On the sales, yes, you're gonna get rid of the accounts receivable from your balance sheet, but the secured borrowing, you still hold accounts receivable, right? That means the sales approach can produce lower total asset and produce a higher return on asset. And then second, recognize liability for cash received. Sales, no, right? Because but on the secured borrowing, yes, you still need you basically borrowing money and then you will crediting a liability, right? But the sales, no, you don't, because the cash that you're getting is the proceeds of your sales. And where is the cash received showing in the statement of cash flow? If you sell accounts receivable, that will show on the financing and operating section. But if you secure borrowing, it will definitely treat it as a financing section, right? And recognizing gain on transfer, you most likely if you sell one, but if you borrowing one using accounts receivable to as a collateral to borrowing, not really likely. Okay, less likely. So therefore, sales approach can produce a lower liability because it does not assume liability. And sales approach can produce a higher cash flow for your operation because it can be categorized under operating activity. And sales approach can produce a higher income at the time of the transfer. Hence, a sell accounts receivable is more preferred. Yeah. So when do we consider transferor allowed to treat the transfer as a sales? When does the company has surrendered control over the asset can be considered as a sale. The conditions define transfer of control is A, the transferred asset has been isolated from the transferor beyond the reach of transferor or its creditors. B, each transferee has the right to pledge and exchange the asset it's received. Hence that the people who bought the accounts receivable from you can also transfer to another person without your consent or liabilities. And C, the transferor does not maintain effective control over the transferred asset anymore. So, summarizing, does the financing arrangement meet all three conditions for treatment as a sale? A, is the receivable are beyond the reach of the seller. B, buyers buyer have the right to pledge or exchange. And C, the seller does not maintain effective control over the receivable. If it's all yes to this, then that means you successfully sold your receivable. If no, that means you are borrowing you are using the receivable as a collateral to borrow. And then we talk about if you pledge, if you use accounts receivable as a whole to pledge some certain loans, then you only need to disclose it. If you assign accounts receivable, specific accounts receivable to borrowing as a collateral, then you do need to record as a liability and you recognize the interest expenses, okay? And then in terms of sell receivables, first of all, you have to remove the receivable. You have to record the proceeds and then you have to recognize gain and losses. And there's two conditions. With recourse, that means that you assume the risk of bad debts. Hence that you might increase your loss. And then with recourse means you assume risk of the bad debts and you need to recognize recourse liability. Hence that will affect your losses or gains, right? Reduce your gain, increase your losses. But if without recourse means that you wash your hand, you don't assume any risks. And in terms of disclosure of factoring arrangement of accounts receivable, the information that transferor must provide in the disclosure, including the transfer event itself, any continued involvement with transferred asset, any ongoing risk with the transferor, how fair value were estimated when recording the transaction, and any cash flow occurring between the transferor and transferee, and how any continuing involvement in transferred asset will be counted for ongoing basis. Okay, then as usual, we wanted to catch up a little bit. What is the receivable management ratio? In other words, how do we evaluate the effectiveness of a receivable collection? So first of all, receivable turnover ratio and the average collection period, and these two we talk about in financial accounting, right? So receivable turnover ratio equals net sale dividing average accounts receivable, and average collection period equals 365 days dividing the receivable turnover ratio. Okay, so I think this chapter, the most new one, chapter 7, is the factoring of accounts receivable, or financial arrangement of accounts receivable and notes receivable. Hence, I recorded this video, and I will recording another one. I may recording another one just to catch up what we learned about cash and the internal control, and also aging method of bad debt expenses. But I think you guys are great at this. I actually did a recording one, but somehow the mic didn't work well. It's the quality is really bad. So if I have more time, I'll record one. But if I don't, and during the lecture, I will show you guys more slides and then use the corresponding questions. So I will see you guys in class. Thank you.